Thank you. We're excited about this panel because first we want to start making more as a debate. So the first thing is really great to have a little bit of the perspective from an investor. So Cheryl, like you've been investing through a blue run, and Noah, you exited through 800 million through Moat to Oracle. So it's just really interesting to see sort of both perspective on that. So first thing, when you have a debate, the most important thing is understanding what maybe like the principle of an IPO, right? Like, love to hear first your opinion on what sort of drives sort of the component of going or not going IPO from your perspective.
Okay, is this on? Okay, great. So I think most people talk about IPOs as, the ultimate promised land, right? Like if I have a company that's gone public, I've made it. And in my background, I've been an M&A investment banker. We have had companies exit through M&A at higher multiples than companies that we've had go IPO. But my principle on IPO is that if a company is at a stage where they should be controlling their own destiny, they're profitable, they're growing, they're possibly an acquirer for the future, I actually think it's good corporate hygiene to be a public company. There's a lot of burdens that come with it. Nobody likes doing quarterly earnings. Nobody's team likes managing to the quarter. But I think that it does signal that your company is at a certain size and stage where having public company principles helps you maintain a certain level of performance, and that's a good thing.
So you normally push the companies after a certain time to say, consider IPO.
We ask them to consider it, yes. We don't push or require them to do anything, and actually a lot of times as an investor, I can say that it's better to actually have an M&A exit because we can get liquidity faster and more assuredly than through an IPO. So it's not actually always in our best interest to have a company go public either. But for some of our companies, that is the best outcome.
And Noah, you decided to opt more on the context of going through the M&A. So love to hear your perspective on the guiding principle on IPO or not IPO.
Yeah. Well, first of all, thank you for having me here. We're based in New York, and it's always fun to be out here in the Valley. I think for us, as an entrepreneur, running a public company is a very different thing than starting a company, growing it, scaling it. You're suddenly moving from sort of the early stage, long-term planning to much more quarterly type existence, which for some people is great, but for other people, like myself and my brother and co-founder, Jonah, wasn't what we aspired to be. I think as, I invest a lot, and as I was telling Bedy, the same week that we announced our deal with Oracle in April this year, there was another company that we're an angel investor in and very close with, sort of our sister company called Yext, that went public in the same week. And it's great to be an investor. I know this is an investor conference. It's great to be an investor in a company that goes public, but so I'm very happy to be an investor in that case, but personally didn't want to run a public company. Now, of course, through the M&A process, we're part of Oracle, and so we're sort of a small piece of a public company. So sort of get exposure to what it's like in a big public company. But I think a lot of it comes down to the people. At the end of the day, how you want to live, and is a quarterly type thing appeal to you or not?
And Cheryl did mention, like, for instance, if you have profitable unit economics, or if you're profitable, you should consider you ask founders to consider. So first of all, the question, and to both of you, is let's say you're not profitable, or maybe you're not in the enterprise sector, which are often been like preferred when the current companies that have gone through IPO. Does that mean there is no space for not profitable company or not enterprise / SaaS in terms of like window?
So there's enterprise and consumer, and then there's profitable and not profitable. And so companies fall in any of those four. I think in venture, there's been a lot of discussion around unicorns and whatnot, and we don't think about that so much. Where we try to shepherd our companies is to getting to a place where you can control your own destiny. And that means that you don't need to raise another round of funding, even in the private markets, so you're profitable to some extent. And then that means you can decide if and when you want to be bought, or if and when you want to go public. And I think for consumer companies, especially in the last, I would say 8 to 10 years, a lot of them have been relying on advertising revenue as their primary source of making money. And so in those cases, if they're not profitable, your future is dependent on your advertisers, and ad tech, kind of ebbs and flows, and that's really challenging. So I think that there is a world for consumer companies, and actually in last year, 2016 through this year, 25% of IPOs were actually consumer companies, and a lot of them weren't profitable, but over 85% of companies that went public last year are trading above their IPO price. So the street is not necessarily penalizing companies for not being profitable. I think that there needs to be a strong story for growth. And if there is, and the street understands that, you will be rewarded for it. But you have to do what you tell the street you're going to do, even if you're a consumer company and not profitable.
Yeah, from my perspective, if you're not some sort of predictable revenue, subscription-based or SaaS, I wouldn't even consider it at all, because I think you're not profitable and you can't predict your revenue easily. That just seems like a recipe for disaster. But I think the enterprise sort of SaaS companies, as we were. There's a lot of more predictability, and it makes a lot more sense. And in fact, I was looking just the other day at an index of all enterprise SaaS public companies, and over the last 4 or 5 years, and it was up like just all the companies combined. It was like 60 companies, was something like 400%, way beating all the other indexes. So there's actually in the public market, as an investor, there's a lot of mispricing from time to time. Maybe where in the private market, it's harder to find mispricing. But as an investor, you can. I think there's probably better deals potentially in the public market.
And then sort of bridging a little bit between the public and the private market, like 2016, you had in the US 106 sort of IPOs. That's probably one of the lowest all time. Do you see, and compared to like 400 in the 99, 2000, so we see that sort of big drop on the window of the IPO 2016, 17 is like, I think the last report says like until the last 3 quarters, it was about 100. So maybe even like if it's really great, we're going toward like 120, 130 IPOs. Do you foresee the window changing, like in terms of like number of deals that go through IPO? You did mention like, okay, if you have healthy companies, both Cheryl brought really nicely, like you have the enterprise, you have the consumer, but what would 2018 look like, or what would like in 10 years like the market look like in terms of number of IPOs?
So everybody always compares back to 99 and 2000. And when you look back at that time, there's a couple of interesting things. First of all, in 99 and 2000, the average time for a company to go public was 5 and 6 years. And ever since then, it has never been at that level since. The average has gone somewhere between 8 to 10 years, sometimes 11 years in any given IPO vintage year that you look at. And so I think we all have to forget about 99 and 2000. Like, it's not going to happen again. It shouldn't happen again. That was like a weird anomaly that we were all very exuberant about. And then we all lost money. So we've learned. And so I think we're in this like good, healthy, like new world order, or maybe like the original world order. So I also don't measure it by number because I think it's so difficult to make this generalization, right? So I think each company that goes public has a reason why they're going public, why they should be a public company. And, you know, to Noah's point, I agree. Like enterprise software companies, because of the predictability, it's easier, it's smoother, it's a more natural thing to happen. I think the flip side that we also have to look at is what has M&A activity been looking like? So when you have, you know, 700, 800, $1 billion M&A exits, those are like small cap public companies. Like that's a very good outcome for the entrepreneur, for investors. So I think you have to look at those two together and say, is that a good predictor of startup ecosystem health and exit, and not just the number of companies? But yes, 2016 was like the worst.
Yeah, I mean, I think there's also a lot of alternatives now you know, you have to go back to what's the point of the IPO? Is it liquidity for the investors? Is it a currency to buy other companies? Is it raising money? I think now, different from sort of the dot-com boom, there's each of the things that you might be trying to achieve, there's alternatives now, including probably the most recent one, the ICOs, where you don't even have to give away equity. You just sell something that might have value. So I think that you have to really, when you're making this decision to sort of to take a company public or not, you really have to be true to what your goals are and make sure, because there are alternatives for each of the things you're trying to achieve, and so you have to really look at it and say, you know, some people, it's just, you know, I know entrepreneurs who just the prestige of taking a company public is what they're after, and that's okay, and that could lead to other things. So, but I think when you're sort of from the entrepreneur perspective, you really have to decide, why are you doing this, and is IPO the right path?
And speaking a little bit of like the health of the ecosystem or the alternatives that we have, we started to see some of those sort of initiatives sort of come together. It can be the ICO or what Eric Riss sort of was putting together in the sort of long-term exchange stock. So you not look only in the short term on the timing horizon, like report every quarterly just for the profit. Like you can look at sort of capturing more in the long term. Do you see, and both from an investor and founder perspective, do you see any of the sort of solution that seems to be popping up, trending maybe to go mainstream, or there seems to be a lot of like different experiments?
There are a lot of experiments. So we've done, so the most traditional paths for us to get liquidity are IPOs and M&A. We have occasionally also done dividends out of our private companies. For whatever reason, the companies just become very, very cash rich, and but they're definitely not at the mark where they can be a public company. So we have done dividends in the past. I think the other thing that we often do is we talk about venture in kind of one mouthful, and there's a big difference between being an angel investor in a company, being in, you know, we're typically Series A only, and then being the last money in before an IPO round. And so for us at the early stage, there's also additional opportunities with secondaries, right? And so to us, our approach is, you know, if we are in very early and in a very late stage or even pre-IPO round, we need to make room for new investors. We may sell some even before a company goes public, or, you know, even if in the next 6 months the company might get bought. So from the investor standpoint, there's always been a lot of creative ways, and even for the founder, right, or founders, there's often secondary opportunities, and those have always existed. I think the challenge with some of these long-term holds is, are you just kicking the can down the road, and how will those investors eventually get liquidity also? I think that just hasn't been worked out yet, but you're basically building like a Berkshire Hathaway, and eventually, you know, you're following an index.
So a bit about sort of the private market, because now, so you have companies are staying private for longer, and you have a lot of cash in. So you have $100 billion fund funding, whether it's WeWork or Uber. Like, what do you think like first, like what's the shift and the motivation often from the founder perspective then to go public, because then you have to go through like the quarter report. So I'd love to hear a little bit of that perspective on when you look at the late stage, there's way more capital in. What is sort of the implication from the sort of healthiness or hygiene from the market?
Yeah, I mean, there's, I think, a ton of secondary opportunities now where, certainly in cases where the entrepreneurs, this might be their first exit, and it might be a life-changing amount of money that they stand to get. They might, push more towards an exit where if they take a little money off the table in secondary and sort of, handle their sort of needs, and then, maybe more oriented towards a longer term approach. But there's a huge opportunity for secondary. I mean, I think there's huge funds now who just do secondary. Typically, you have to get to a certain size, either revenue or valuation. But certainly, in our case, when we were exploring different options, that was an option that was, very much on the table by investors. I think some people, I think it can be a good option, and especially if they do want it, because an IPO ultimately is not really an exit. The management team typically is not going to sell for some long period of time after an IPO. So if a company is going to go an IPO, I think doing a secondary first so that the team can get some liquidity probably makes a lot of sense.
As you were raising sort of multiple rounds in your sort of financing, did you do some secondary, or is that normally like your current investor you offer in the more in the private way, or you saw some of the options from the market to work with some sort of different services to get those secondary, almost like a marketplace in?
Yeah, I think, I mean, there's all sorts of options. I mean, there's, I think in the sort of the larger, sort of more famous consumer ones, like an Airbnb type company, where they're like, marketplaces and so on. But I think there's, tons of secondary that people can do. I think it's a good thing. It used to be that it was frowned upon if an entrepreneur took $1 off the table because there was this perception that they weren't in it. But in reality, they might just have stuff in their life that they need some money for. So I think it's a good thing, and I think there's tons of opportunity for it.
We don't discourage our founders from taking some money off the table. I mean, it's not going to happen in the Series A. There's definitely there's a right time for it. And I think the other piece that we really look at carefully is, does the founding team or management team have enough skin in the game? And a lot of times by the later rounds, there's been so much preference that's been put on top of the team that, there needs to be some kind of refresh. So somewhere along the natural course of a startup, there is that discussion. And I don't, to your point, I don't think there's stigma around that anymore. I think that is part of having an open relationship with your investors. And sometimes the amount is really small. I mean, it could be like, I have $80,000 worth of student debt that's hanging over my head, and I've been living on ramen noodles for 3 years, like, paying myself nothing. Like, can you just pay off my student debt? Does that mean that you're not motivated? Not at all, right? So like there's, and it doesn't seem like a large amount of money in absolute dollars, but to your point, like it's life-changing because it just takes off some of that pressure. And so we see that a lot, and it's a good way to just always align interests between the founding team, the investors, and just making sure that you pave the way for the company to have the most options possible, like the whole way, because it's a long journey.
And you see that happening normally after sort of Series B or C within your portfolio, or much later?
So this is a really weird investing environment, because seeds are like A's and A's are like B's. And so it's kind of hard to pin it down. We're seeing some of our entrepreneurs ask for, a small amount to be taken off, usually sometimes in the B. And it's usually very, very small. And it's usually to take care of things like student debt or like, stuff like that. Usually the big secondary sale is not happening until kind of more of like a Series D or sometimes even later. And then companies who really are imminently about to go public, the founders don't want to do that either because they have the best visibility into what those companies are going to be doing. And so they think that there's probably more upside in the public market, so they want to hold. So there's this window, I think, in the late stage.
We're opening for some sort of additional questions from the audience, and I think maybe Cheryl, that's a question for you because you were mentioning a little bit about social capital, where we're doing a discussion on like sort of alternatives for maybe IPO initiatives, for instance, like social capital is doing. Love to hear a little bit more your perspective there.
I think venture is going to change dramatically over the next 10 years. And I think social capital is doing some really innovative things to kind of test. We're doing product market fit testing all the time as well, or we should be as an industry. And so I think that they're doing some interesting things. They're looking at what founders need, what their investors need, how can they make money in this market. And I think creating different products is going to be really important. And I mean, we're a financial service, right? Venture as an industry, we're basically just a financial service, and our one true north is to make money. No matter what we say, like, yes, we want to help founders realize their dreams, all that stuff, but our goal is to make money, and that's why you as LPs give us money. And so looking for different ways to do that. And I think the thing that all VCs look back and regret is like, man, I should have sold that sooner, or gosh, I wish I would have held that. And so creating different vehicles to find creative ways to meet all the different dynamics of different types of investments that we do are going to be really important. So I commend them for trying a bunch of new things. I think it's not going to be for every venture firm. So we'll see, but I think it's definitely very innovative.
And both of you do like category on like early stage, right? I think you're more on the angel investor side. So what's the biggest challenge when you do early stage investing when companies are staying private for so long?
I think one of the things you realize when you start doing early stage is the horizon. How you don't always realize how long it is, and it easily be 8, 9, 10 years for the good ones.
Is that your expectation when investing 8, 10 years?
For
15?
I don't think I realized that when I started angel investing that you want that, because if you invest in 10 years later, the company's still doing well, it's going to be probably a pretty good outcome. The bad ones end quickly. But I don't think you realize that, and I don't think, at least I didn't realize it, that how long of a time horizon it really was.
Oh, what's the biggest challenge, Cheryl, for you, like the fact that companies staying private?
Definitely everything that you said. I think also understanding are companies taking longer to go public just because it's just it's the natural arc of the business, or they're going to be very capital intensive. And if they're going to be very capital intensive, that opens up a whole array of issues. So even for us, our typical model is to invest somewhere between $2 to $5 million initially, and then we have reserves for follow-on. And in general, we invest somewhere between $12 to $15 million per company over the life of it. As an angel investor, you may not even have like that deep of reserves. So if a company's going to be around for a really long time, and it's like round after round, and to Mark's point earlier today, you set the price and we set the terms. There's some pretty punitive terms out there right now by late stage investors, and so if there's pay to play or anything like that, then you need pretty big war chest to be able to support your investments. And that's one of the challenges if a company has been around for a really long time and ends up being capital intensive. So we try to kind of vet that early on and really understand, again, how much capital and time do you need to control your own destiny, and that's the number that we look at.
There was the question around one thing that you don't know, or other things that you don't know about that it's not well known on the IPO. I think I would put it a little more specific because both of you went through the experience, whether it's through the Copa or Yext. What was surprising for you when you were doing the IPO and after IPO on your experience? Because I think that applies directly to the company you were following.
I think one of the things that's interesting with the IPO that maybe you don't think about as much is you go from a scenario where you know your investors, you chose your investors, you have a relationship with them, to a scenario where you have no idea who they even are, or what their goals are. Are they shorting your stock? Are they long your stock? You know, what are they doing and who are they? And I think maybe people don't think about that as much. But there's a lot of sort of Wall Street dynamics that you don't even have to factor in when you're a private company. But suddenly you're dealing with all sorts of things that you probably have never dealt with or maybe even thought about.
One interesting thing that I didn't really expect as much. So when Coupa was getting ready to go public, it was a conversation. It wasn't like one day you wake up and you're like, today's the day. There was a whole process, right? And I was actually very surprised at how transparent the process was and how much guidance they had gotten from bankers in the street. Like, okay, right now we're valuing profitability over growth. And so, what can you do over the next 2 quarters to prove that you can be a more profitable company even at the sake of growth? And so for an enterprise software company, you can actually turn those knobs and you can adjust profitability for growth, and you can make those trade-offs, just how much you spend on sales and marketing, for example. So I was actually surprised that there was so much information exchange in terms of these are the goals that you need to hit, and if you hit them, you'll probably have a successful IPO. I thought it was going to be a little bit more of a black box, that on the day things started trading, you wouldn't know what would happen, and actually you really knew what was going to happen. That was kind of surprising.
And no, you're based in New York and here, and Cheryl, you're here and travel also around the world. If you have a wish list, because if we look at IPO at a global level, if you have a wish list or one wish, what the IPO 2.0 would look like, what would it be? That's my final question.
Let's see, what would be my wish? I wish that we would think of IPOs in a little bit less of a rigid way. I think that it's actually, companies are it's not as easy to pinpoint a company into one sector anymore. Enterprise software is the easiest, or semiconductors are the easiest, but we were talking about some tech-enabled consumer services, right? Are you a food company or are you a commerce company? Are you a fashion company or are you a commerce company? And traditionally, tech companies have gotten the best multiples. And so I think what happens is that there's all this posturing that's happening when companies are getting ready to go public so that they can get the tech multiple. And one of my wishes is that Wall Street and all investors take time to kind of really understand the inherent business drivers of a business and not try to force fit them into a specific industry multiple, because I think that is something that really hamstrings long-term growth. And to your Noah's point earlier, that's why people don't enjoy being a public company, because they have to manage the quarter as opposed to the long-term vision. And if you're going to be penalized because you're going to get a fashion multiple or, a financial services multiple instead of a tech multiple, then that's very discouraging for a founder or a CEO who's trying to be visionary. So I think that's my one wish.
I guess my wish, even though we chose not to go public, that I do wish that there's more companies in New York that go public and are successful and are long-term companies, build over 10, 20 years. I think New York is a great place to start a company, build a company. I mean, we also have offices here and other places around the world, but there's not a huge number of big public tech companies in New York. all of the big tech companies have presences there, but there's not sort of headquartered major tech companies for the most part. And so I do think, and I do hope that that happens, and it sort of stabilizes the environment and provides a level of sort of experienced talent and so on and so forth. So I hope, and I think there's a crop of companies that can be public. I mean, there's also companies could go public and then get bought, right? But I guess what I wish is there's companies that go public, stay public, and stay grow long term in New York.
Cheryl, Noah, thank you so much for giving us a lot of insights around the principles and give the perspective from investor, founder, also sort of early stage, and the wish list for IPO 2.0. Thank you very much.